Hey everyone, and welcome to this explainer. Today we're putting on our professional equity analyst hats to conduct a really rigorous from the ground up valuation of TG Therapeutics, trading under the ticker TGTX. We're going to perform a complete forensic teardown using just the raw financial filings and metrics. The goal here is to strip away all the market noise and apply absolute, relative, and asset-based valuation models to figure out what this company is actually worth. So if you're ready to crunch the numbers and hunt for true intrinsic value, you are absolutely in the right place. Let's get into it. Okay, let's dive into this. The current share price of TG Therapeutics sits at $33.85. Now, you know the drill. The market tells us what a stock costs, but our job as analysts is to figure out what it's actually worth. Is $33.85 a steal, or is it heavily overvalued? To answer that, we have to pop the hood and systematically break down the financial engine driving this stock. Right out of the gate, we smack into the central puzzle of our valuation. Over the trailing 12 months, TG Therapeutics reported a massive net income of over $447 million. But wait, their free cash flow is a negative $24.9 million. I mean, how does a company look so wildly profitable on paper, but still bleed cash in reality? This glaring contradiction is exactly why we can't just rely on a single metric. We need a comprehensive valuation approach to solve this mystery. Here is our game plan for today. We'll start with the TGTX financial profile, then move to absolute valuation models, check out relative valuation, conduct an asset valuation, and finally synthesize the whole shebang to find the true intrinsic value. All right, Section 1, the TGTX financial profile. What's really fascinating here is the sheer efficiency implied by the raw data. We're looking at a $5.4 billion market cap, up 13.55% year to date. But the standout metric? That has to be the staggering return on equity of 69.01%. When you combine that massive ROE with a very conservative debt-to-equity ratio of just 0.38 and a high current ratio of 4.10, it paints a really interesting picture. We're looking at a moderately leveraged, highly efficient biotech firm that is generating massive returns on invested capital, even if that cash isn't immediately showing up on the free cash flow line. Moving right along, Section 2, absolute valuation models. So our first absolute model is the classic discounted cash flow, or DCF. But we immediately hit a brick wall. Usually you project free cash flow, right? Well, TGTX has a trailing free cash flow of negative $24.9 million. A traditional DCF is incredibly fragile, almost useless, when you're starting from a negative cash flow position. Now, a professional analyst might assume a default weighted average cost of capital of around 10% for biotech risks, and maybe a standard terminal growth rate of 2 to 3%. But thankfully, we don't have to guess. The financial metrics provided actually hand us a hard anchor, an EPS-based fair value calculation coming in at $64.20. Since the cash flow model breaks down here, we're going to lean heavily on this EPS-derived intrinsic value as our absolute baseline. For our second absolute model, the dividend discount model, we can be incredibly brief. We're just going to toss it out entirely. The source data shows a 0% dividend yield and a 0% dividend compound annual growth rate. You literally can't discount dividends that don't exist, so let's just keep moving. Which brings us to our third absolute approach, the residual income model. Now, let's see how this builds, because this model is exceptionally strong for TGTX. Why? Because it leverages that massive $447 million net income instead of the negative free cash flow. You start with a book value of equity, subtract an equity charge, which is basically the minimum return investors demand, and what's left over is your residual income. Given the company's jaw-dropping ROE of 69%, which far exceeds any standard cost of equity, this model points to a massive premium over book value. It heavily supports the idea that the stock's intrinsic value is way, way higher than its current trading price. Let's pivot to Section 3, relative valuation and multiples. So the crucial point here is that since our data doesn't explicitly list competitors, we have to benchmark against sensible assumed averages for a profitable mid-cap biotech peer group. And when we do that, we get a completely mixed bag. On a price-to-earnings basis, TGTX looks incredibly cheap, with a PE of just 12.22, compared to an assumed peer average of around 20. But then look at the enterprise value to EBITDA. It's sky high at 44.74. And its price to sales of 8.79 and price to book of 8.11 also suggest a pretty steep premium. So why the disconnect? Well, it likely traces back to that accounting net income anomaly we noticed earlier. The earnings look massive, driving the PE way down, but the operating earnings, the EBITDA, don't look nearly as strong relative to the firm's total enterprise value. All right, Section 4, Asset Valuation Approach. We can actually back into the net asset value mathematically using the ratios provided to us. With an EV/assets ratio of 5.19, we divide the enterprise value by that multiple to find the fair value of total assets. Then, applying the 0.38 debt-to-equity ratio gives us our estimated liabilities. Subtracting those gives us our implied NAV. Basically, because it trades at over 5 times its assets, the market is clearly pricing in a massive premium for future intellectual property, way beyond any physical liquidation value. And finally, Section 5, Synthesis and Intrinsic Value. Let's pull it all together. When we line our results up side by side, the discrepancies are pretty wide. Though, to be fair, that's pretty common in complex biotech valuations. Our EPS-based absolute fair value model strongly points to $64.20 per share, but our relative models are split down the middle. The PE ratio implies the stock should be trading much higher, while the EV/EBITDA and price-to-book multiples suggest it might actually be overvalued right now. So as professional analysts, how do we actually weigh these conflicting signals? Well, we know the traditional free cash flow DCF is basically useless here. Negative inputs create garbage outputs. The relative models are skewed heavily by accounting definitions of EBITDA versus net income. However, the residual income model loudly confirms that a 69% ROE is creating immense shareholder value. Therefore, without stable cash flows to rely on, that EPS fair value of $64.20 provided in the data serves as our most reliable, mathematically sound anchor for intrinsic value. And this brilliantly illustrates our final takeaway. Based on that EPS fair value anchor of $64.20, the data calculates a massive margin of safety of 47.27%. To put that into perspective, it means that based purely on its earnings power, the stock is trading at a near 50% discount to its intrinsic worth. Which leaves us with this final thought. At $33.85, the earnings models are screaming that TG Therapeutics is significantly undervalued, boasting a 47% margin of safety. Yet, that negative free cash flow and the high EV/EBITDA multiples urge a bit of caution. So I'll ask you, does this margin of safety make TGTX a heavily undervalued asset just waiting to be realized by the market? Or does that negative cash flow signal a trap for the unwary investor? It is a fascinating standoff between on-paper earnings and raw cash. Thank you so much for joining me on this explainer and keep digging into those numbers.